Right now, the AI market is entering a completely different phase. Headlines focus on trillion-dollar companies, massive GPU demand, and billion-dollar data center expansion. But underneath all that noise, a quieter layer of the market is starting to form. Historically, this is where some of the biggest asymmetrical opportunities appear first. While most retail investors chase expensive AI names, smaller companies in automation, digital infrastructure, and AI systems trade under $5. One stock we're covering today trades around $1.59 per share. The other, roughly $4. Both are connected to areas that could become increasingly important if AI adoption continues accelerating. Are these simply cheap penny stocks, or hidden AI growth plays the market hasn't fully noticed yet? This is where things get interesting. The AI race is no longer just about chatbots. We're seeing expansion into intelligent advertising, automated workflows, creator tools, predictive targeting, and AI-assisted infrastructure. Whenever a major technology shift happens, attention usually concentrates on a few obvious companies. But here's the part most people miss that creates pricing inefficiencies. Institutions look deeper into supporting AI layers, while retail investors often chase big names after they've exploded. Meanwhile, smaller cap infrastructure-linked companies can stay overlooked for much longer. This doesn't guarantee anything, but it explains why this area matters. Historically, some of the strongest percentage moves come from sectors investors ignore early in the cycle. This is the type of layer institutions quietly watch before broader momentum arrives. This is exactly where smaller cap opportunities tend to form. The first company operates in a part of AI most people never even think about. Instead of flashy chatbots or hardware, it focuses on behind-the-scenes behavioral targeting, predictive intelligence, and digital intent analysis. At first glance, that may not sound exciting, but modern AI systems increasingly understand what users want before they express it. This company operates directly inside that layer. The second stock, later, focuses on creator ecosystems and digital production workflows. But for this first company, the story is really about invisible infrastructure. As AI adoption expands, businesses search for smarter ways to target consumers, reduce advertising waste, and improve automated engagement. That's where this type of company fits. Instead of competing with massive AI hardware firms, it operates inside the intelligence and targeting layer connected to digital advertising. If this layer expands alongside broader AI deployment, companies like this naturally become more critical. The future of AI advertising is likely about precision, prediction, and automated optimization. This company is already positioned inside that ecosystem. Now let's talk about stock movement. This company previously traded at significantly higher levels during earlier speculative tech cycles. It pulled back sharply as small cap momentum cooled, then stabilized near lower price ranges as investors shifted attention to mega-cap AI names. But now the question becomes, if AI-powered advertising infrastructure scales, could smaller players attract renewed attention? Because timing changes everything in penny stocks. The company focuses on AI-driven advertising technology to analyze consumer behavior and improve digital targeting efficiency. It operates in a real business environment tied to automated advertising optimization and predictive audience systems. As companies prioritize smarter ad spending, this layer becomes more relevant. And this is where things shift. When you look at the company behind this AI advertising infrastructure, you find Inuvo Inc. ticker, INUV. Current price, roughly $159 per share. What makes this interesting is the disconnect between market attention and the area the company operates in. AI advertising infrastructure simply isn't getting the same excitement as GPUs or trillion-dollar AI giants. That creates possible pricing inefficiencies. But this doesn't mean it moves tomorrow. There are risks here. Small cap volatility, Execution challenges and broader market weakness can all impact performance. Timing is the key factor. Before we get into the second stock, here's something most people completely overlook. Even though AI demand is exploding globally, some supporting infrastructure companies are still seeing delayed market reactions. Historically, delayed reactions are sometimes where institutions quietly begin positioning before retail momentum fully arrives. Which brings us to stock number 2. Unlike the first company, which operates more inside AI-driven advertising infrastructure, this one sits closer to digital creativity, creator ecosystems, and AI-assisted production tools. That creates a very different type of opportunity. Instead of focusing on data targeting, this company focuses more on personalized creation and digital workflow systems. Now, this is where things get interesting. As AI expands into automated design and content generation, companies connected to creator ecosystems could become increasingly relevant. This company combines software, hardware, and digital design tools into one connected ecosystem. Users can create customized products using digital workflows tied directly to physical production systems. As AI-assisted creativity tools improve, platforms like this could benefit from smarter automation and personalized content generation, which gives it a completely different AI angle compared to the first stock. If AI adoption continues accelerating across creator tools and digital productivity systems, this type of company naturally becomes more relevant. Because AI isn't only changing enterprise software, it's also transforming how people design, customize, and produce digital content. Companies already operating inside those ecosystems may have an advantage if adoption expands faster than expected. Now let's look at the movement. This stock traded dramatically higher during previous growth cycles before experiencing a major correction. Since then, it has stabilized closer to lower price levels. But now, investors are asking a different question. Could AI-enhanced creator tools eventually bring renewed attention back to companies already positioned inside digital production ecosystems? And this is where it gets interesting. The company is Cricut Inc. ticker, CRCT. Current price, roughly $4.01 per share. What keeps this company relatively overlooked is that many investors still view it as a traditional crafting business, instead of part of the broader AI-assisted creator economy. And that perception gap matters. But this doesn't guarantee anything. There are real risks here. Consumer demand weakness, slower adoption trends, and execution challenges could all impact future performance. So now we have two completely different AI penny stock setups. The first company focuses more on invisible advertising intelligence and behavioral targeting systems. The second operates closer to AI-assisted creativity and digital production ecosystems. That creates an interesting tension for investors. If AI expansion accelerates through automated advertising and predictive targeting, the first stock could benefit faster. But if AI-powered creator tools and digital workflow systems scale more aggressively, the second company could become increasingly important. One is infrastructure-driven. The other is ecosystem and creator-driven. One depends more on AI data efficiency. The other depends more on AI-assisted customization and digital production trends. Both are still trading under levels where mainstream market excitement usually appears. So the real question becomes, which one benefits faster if the next AI expansion wave accelerates? The bigger story here is that AI expansion is spreading far beyond just chips and mega-cap software companies. Now, the market is moving into advertising systems, automation layers, predictive intelligence, creator platforms, and digital production ecosystems. Historically, this is the layer that tends to move later, but often more aggressively once momentum finally arrives. That doesn't mean every company succeeds, but it explains why institutions quietly monitor overlooked sectors connected to major technological shifts. Before retail attention fully catches up, if you enjoyed this breakdown, make sure to subscribe. Let me know which of these two AI penny stocks you think has the stronger long-term setup moving forward.